to everybody, and we're live. Welcome to the morning show on Beyond the Markets, and welcome to Wealth Wednesday. I'm your host, Munyumu Mutwale. Thank you very much, and I am here with my lovely co-pilot, Stephanie. How are you doing today?
I'm fine, Munyumba. How are you?
I'm fine, thank you. And it is the midweek, 2 days till the budget, 1 day till Money FM turns the wonderful 20. The wonderful five. I'm busy thinking Money FM is turning 20 yet. When children start growing up, you start thinking, the years are flying. But yes, it is a wonderful, wonderful day, and to everybody, get ready for the moment. But let's get first into Wealth Wednesday data, Stephanie, as we get into some of the news and some of the market analysis. So starting in, kicking into Wealth Wednesday, we do see that the Kwacha has continued, did actually now gain a little bit of ground yesterday after continuous losses, up 0.1%, but the dollar is up 1.1% on the week and 5.39% on the month and 16.29% year to date. The stock market shifted down a little bit with movements up in some of the major stocks, but unfortunately there was some movements down in your Puma Energies, CEC Africa, and some of the other, not CEC itself, but CEC Africa. We did also see the stock market is up 0.94% over the last 7 days and up 6.27% over the month and 26.02% year to date, while the bond index is up 0.16%, with bonds in dollars down 0.15% and interest rates continuing to slide down after the huge spike that kicked in. We do see that the rand is also down 1.54% from yesterday's movement upwards of the dollar of the kwacha. You did see that it was an upwards. The rand is still up 3.62% year to date, but up 2.85% on the month. So volatility in the rand is still a big problem, though we're seeing 50% movement up and down in terms of prices. Now, in terms of the bond index, we do see that bonds are up 20.18% year to date, while 3.23% in US dollars on the month, with the GRZ bond index up 0.92%, down from that 0.98%, but still we're having problems keeping that. Sorry about that. Simultaneously, we did see that copper. So we did see. Sorry about that. Simultaneously, we did see that copper is down 0.4% as of yesterday, as we're seeing a lot of the metals and the industrials coming down, while oil is up 0.05%, still with US, with even though in the face of US inventory buildup, a surprise US inventory buildup, while we see gold down 0.18% as of yesterday. Now, we still are looking at about a 33 kwacha pump price as our predictions, which we're expecting by the end of the week on Saturday, which we should see the ERB announcement. The prediction will be anything above 33 kwacha at the pump. Other news that we also did see is in terms of cryptocurrency, Bitcoin down 0.5%, Ethereum down 0.2%, while gold down 0.591%. Due to the weakness, the strength. Sorry about that. We're having a little bit of a difficult morning today, technically. And lower performance that we did see from the metals themselves, from the base metals themselves. Simultaneously, we are also seeing that across the board, we do see that bonds are up 20.2% year to date, stocks are up 26% year to date, USD is up 16.3% year to date, while gold is up 22% year to date. Sorry about that, people. We just are trying to fix our sound issue. Up 22.2% year to date gold. And we're also seeing that Bitcoin is up 83.7% year to date. But remember, this is highly volatile. So if we do, hello? Sorry, yeah. I'm not sure if we're getting a little bit of feedback here from in studio. Not sure if we're getting a little bit of feedback from in studio. However, if we
All right.
do see,
I think that's
pardon?
the feedback. It's been
Yes.
written.
Hello, just checking.
Right.
Check two.
So
Right.
just to remind those that are listening to the mainstream, you can
Okay, thank you very much. And we are actually back. Sorry about that, Stephanie. We just did a little bit of a sound issue on my side. If you look at the quarterly data, you do see that bonds are up 6%. From the last 3 months since the end of quarter two. Stocks up 12.2%, dollars up 19.7%, gold up 19.1%, Bitcoin up 2.6%, and Ethereum down 20.9%. So this is why I said your cryptocurrency bet is a little bit difficult. If you look at the second quarter as well, you can see negatives there. So these are very volatile. They have not performed in the last 2 quarters. Where you've seen consistent performance is the bonds and stocks, because USD, you can see that they've countered each other, gold has countered each other, while Bitcoin and Ethereum have had net losses from this quarter stemming from the last quarter. So we can actually see that the only continuous performance that we've seen, if you're looking at compound performance since quarter two, is bonds and stocks, and that's when you've seen it managing very well. Now, in terms of our four horsemen, you can see that the BOJ's core CPI has stayed the same at 3.3%. That's a headwind, elevated inflation. While a tailwind is showing that crude inventories did actually build up in America, showing that there is some pressure to at least push down oil prices, but not too much. Remember that it's supply side issues that are pushing this up. Italian 2-year bonds, you can see interest rates rose. German 5-year bonds interest rate rose, and US 2-year notes also interest rates rose. So we're seeing higher than usual interest rates. Building permits in America did pick up. However, Canadian manufacturing sales slowed down. US housing prices picked up, while Chinese industrial profits continue to stay in the negative, while manufacturing in Korea. So mixed data coming out of industrial. While in terms of income, in terms of the main side of the economy, German business expectations dropped, while Red Book sales in America picked up to 3.8%, while consumer confidence also came down in America, showing that they are headwinds. So we are seeing growth headwinds really picking up with elevated inflation, elevated interest rates, slow growth headwinds, and mixed data coming out of the industrial sector. Now, in terms of our deep dive, let's take a look at some of the news headlines that came out yesterday. China Non-Ferrous Metals Group Corporation did announce that they're going to put a 1.3 billion investment over the next 5 years in mining in Zambia. They are looking at a $600 million investment in Shaft 28 for Luanshya Copper Mine and corporate social responsibility programs. NFAC also plans to increase its production to 110,000 metric tons per year, marking 25 years in Zambia. They have invested $1.5 billion cumulatively, and its subsidiary Chambishi Copper Mine has actually managed to produce 67,600 metric tons of copper in 2022 and 54 kgs of gold in 2022. So you can see that there is a bit of a push here in terms of the price, in terms of getting the metal prices up. So you can see that they want to basically almost double their production within the next 5 years. So we're looking at about 2028. We're likely to see it. This is marking 25 years of non-ferrous metals. Obviously, they've had some issues in the copper belt mining sector, but you can see that they are pushing for some of their activity. As well, the Gates and Bezos backed Cobalt Mine Metals is to build its copper mine within the next 10 years. The California-based startup has actually said that it's earmarked $150 million in Mngombo project, and is estimated to cost $1 billion, with a joint venture between Australian private equity group EMR Capital and also ZCCM. So that's one of the things that they are pushing for, and they're using AI obviously to track where the best deposits are. Cobalt plans to look for more deposits also in Zambia that are as large as Mngomba. So yeah, Mngomba, and also they're also looking for prospects in Botswana, Namibia, and Democratic Republic of Congo, mainly looking for EV metals. So you can see the race is on. We're now in a space where people are coming in with AI military, effectively, to try and look for as many EV metals. Obviously, you do also see them trying to build out the Lobito corridor all the way that side to Angola to see if there's an exit point that can also help Zambian and DRC metals get to the Atlantic as opposed to go into the Indian Ocean, which is heading towards China. Other news that we did see yesterday, the big news from yesterday is British American Tobacco's mid-year report. We're going to be doing that today, as we're now doing our earnings series. Every day I'm going to be dropping one of the earnings notes today. British American Tobacco growth continues to slow down as the illicit market continues to push profitability down and to add pressure to the stock. This is why I'm looking at it as a hold and a tentative sell. This stock is actually under pressure from a business risk. This is not just a financial performance issue. There is a fundamental business risk with the cigarettes market, and also this is a sin stock, so you expect it to give you much higher returns, but it is struggling right now. When the apparent high levels of the illicit market are impacting the industry substantially, industry sustainability. In fact, it is estimated from the 2021 reports that the illicit market is as big as 30% of the full cigarettes market. So the cost of operations basically also did go up by 13% to 180.7 million kwacha, mainly due to the impact of the currency devaluation on the cost of imported raw materials. So you can see that the kwacha weakness is hitting badly against British American Tobacco. So their margins are getting compressed. The illicit market is taking their sales. They are suffering from a similar problem you're seeing from national breweries, except they are a bit more profitable. So you can see here from a marker of their mid-year annualized EPS, earnings per share. So they did manage to start a recovery. 2020, they were negative. 2021, they bounced back. 2022, they came in very strong. But you can start to see the illicit market is shaving off, and also the FX market is shaving off returns. As you can see, the profits of the company dropped from 57 ngwe per share to 48 ngwe per share as of this year. You can see even the mid-year annualized price to earnings ratio, however, does show that the stock is still underpriced. So remember that the benchmark is about 7. So we do still have a strong PE ratio that has stayed in good pricing zone. So the stock is still relatively underpriced, but the future of the company still has a relatively high business risk. And I think that's my main issue. As you can see, the 5-year revenue history, the 5-year financial history of British American Tobacco over the past 5 years, you can see that it's moved up. The revenue has continued to grow, though it has slowed in growth. The problem is you can see profitability growth. Profitability growth has really come down. We've gone from 95,000 kwacha 95 million kwacha operating profit to about 89 million kwacha operating profit, which therefore dropped from 61 million kwacha net profits to 51 million kwacha net profits. That's where the problem has kicked in for the company. If you look at the growth, and you can see there's been a significant, since 2021, we have seen significant slowdowns in the growth of this company's and the growth in all layers. So you can see even revenue growth has slowed 48.27. You can see that net profit growth has gone down from 52 all the way down to negative 16. So you can see momentum in the earnings of this company is also moving negative. Margins as well have started to compress since 2021. You can see margins which peaked, gross margins which peaked at 67% are now coming down to 63%. And you can see that operating margins also dropped last year, while also so did net margins. So you can see it's FX and the illicit market combined together and had a negative impact. Also, in terms of the underpricing, there's a little bit of a negative here. In terms of underpricing, we do see that in terms of by the earnings method, by the price to earnings method, you can see that the stock is underpriced, but it is overpriced according to the book value. So in terms of its balance sheet, it is overpriced. In terms of its earnings, it is underpriced. So there's a little bit of movement, but as I would say, this is more of a hold to sell because of negative momentum. When it comes to the stock, I think for me, the main thing is that there is negative momentum. There is a significant business risk that is actually exhibited in the stock itself. And I think that's where the big part of it comes down. So today's topic of discussion, so for those who are looking, those were the British American Tobacco results that were first half of the year 2023. Negative results for me. You saw slowdowns on the top line, slowdowns on the bottom line, illicit market threats, which are threatening the business case of the stock itself. Slightly underpriced, but unfortunately, that is within the margin point. So if you're investing in that stock, my outlook is if investment in that stock, my outlook is it is a hold to a slight sell. Not a strong sell, but to a slight sell. I don't see much positive. There are too many headwinds that it's battling with, which is the FX rate and the illicit market. Those are very powerful headwinds that it's facing. So let's get into our major conversation, which we've had over the last couple of weeks. I've been doing a section on risk, understanding investment risk. And I have been having this conversation with people mainly because I do see that that our investors are struggling. And I won't say Zambians, I will say everyone, even around the world, struggle with understanding the concept of risk. So remember, we did start by talking about the fact that Warren Buffett's first rule of investing, never lose money. Second rule of investing, always remember rule number one. So that's one of the main things you should actually pay attention to. Never lose money and never forget to never lose money. The three biggest wealth thieves in this world are consumption, spending all your money and not investing it; conservatism, putting all your money in cash or defensive assets; and carelessness, taking unnecessary, unbalanced, and uncalculated risks with money that potentially fail to return the capital that you injected in. So that is part of the main thing. So what is risk? We put it down. This is the probability that things will not turn out as expected. Sorry, I think we had a different one here. Right, so thank you. We actually have Stephanie, who was just on a different line. Thank you very much for joining us again, Stephanie. So remember, we did categorize what is risk. And risk is the chance that the actual gains will not come out as expected. So the risk is always, if you expected an investment would yield 5,000, but it doesn't, that is a high risk. What is the probability this won't work out? For example, if you have a tenant in a rental property, what's the probability that tenant won't pay their rent each month? That is the level of risk that you're getting, because that is an expected return that you're looking at. We talked about risk-free assets or potentially risk-less assets. We talked about risk profiling, how to look at your personal risk profile. I gave you a few tests such as Jungian archetypes, Myers-Briggs, and the Ramsey solutions. Know your personality, know yourself, so that you can know where you fall in the risk spectrum. Are you a protector, a planner, a pleaser, or a player? Who are you in terms of the risk spectrum, and where do you fall? We talked about the types of risks last time, and we really went into business risks. So you can see I utilized that when I was analyzing British American tobacco shares. Operational risks. We talked about legal risks. So we talked about legal risks, credit default risks, country risks, foreign exchange risk, which BATZ is also facing, interest risk, reinvestment risk, political risk, counterparty risk, liquidity risk. So these were the types of risk. When you are looking at an investment, these are the types of risks you should be looking out for. There are many more, but these are the headline kinds of risks. So today I want to talk about risk versus reward. So I want you to understand, why do we track risk? Risk is the cost of investing, okay? So the cost of trying to build wealth is taking risk. So I want you to think about that. That's what you need to look at your mind. So for every reward you look for, the cost is the risk you must take. So every step forward requires a risk. Every action requires a risk. So what you are looking for is not to remove all risk, but to take not too much risk. You want to calculate, know, and manage your risk. That's really what you want to do. You really want to calculate it. Because if you eradicate risk, the only way, Stephanie, to eradicate risk is to do nothing. Okay?
Munyamba, seems like we have a phone call. Should we pick it?
Yes, please, go ahead.
Hello? Hello? Okay. So this one seems to have lost connection once again.
So we were going through the conversation of risk and reward, saying for every reward you seek, there is a risk you must take. And that is the reality of everything. If you want a gold medal in running, you actually have to run the race and risk losing. Okay? You have to risk not being able to get it. So the balance between desire of the lowest possible risk and the highest possible outcome. That is risk reward management. And this is based on factors such as age, income, time horizon, liquidity needs, personality, investment goals. So you kind of say the higher your income, the more risk you're willing to take. The longer the type of investment goals also affects the risk you're willing to take. How urgently you need this thing in cash format affects the risks you're willing to take. That's called liquidity needs. Time horizon, the longer you're investing, affects the amount of risk you're willing to take. And even your personality affects the amount of risk you're willing to take. So these are the things that affect. For example, let me give you an example with investment goals. If you're saving for your retirement that's 20, 30 years away, you can afford to take a little bit of risk. But if you're not saving for your retirement, maybe you're saving for your child's education, because that's something you want to take, you really want to be certain about, you will put that in assets that are a little bit less risky. So you become more adverse to risk when you take into consideration risk reward. So keep in mind, the higher the risk does not automatically mean high returns. There are some things which are high risk, low returns. Okay? Like storing money, like in real terms, storing money in a deposit. That is high risk, low return because it's volatile due to, unfortunately, or it's not volatile, sorry, I'm talking about US dollars. Those are high risk, low return. Dollars themselves, keeping your money in dollars is high risk, and it has unfortunately been a low return over the last 22 years. Over the last 5 years, yes, they've performed well, but over the last 22 years, the dollar has performed pretty poorly. Okay, in terms of the long-term investment spectrum, in fact, it's been the worst. So we have something, Stephanie, called the risk-reward ratio. And basically, the prospective reward of an investor that an investor can earn for every dollar or kwacha they risk in an investment is used to compare against the expected returns of that investment. So let's say, Stephanie, you make an investment in a deposit. Okay, you expect to make 13% on that money. Say you've done a microfin deposit, you expect to make 13% on that money, but the risk you take maybe is it could easily vary from that 13% by 10%. So it could easily be 3% minus 3%. It can be anything. Okay, it can be 3% minus 7%. It could be 23%. It varies. So you take the expected return, expected risk, you'll take, which is the standard deviation, which is 10%. And this is calculated by an investment analyst and divided by the amount of money you wish to make. So what we're simply saying that you should know, a good investment is one, Stephanie, which is the best investments are the ones where the risk is 1/7 of the return. So how much you expect to make, how much risk you wish to take should be 1/7. That's a very safe investment. A decent investment is 3-to-1, okay? Where the amount of money you stand to make on an investment is 3 times the risk you need to take. And a very risky investment is one which is less than 1 to 3. In fact, it's one where the risk is higher than the return. Okay, the stock market, for example, the risk is higher than the return in Zambia, and I'll show you risk-reward ratios when you look at the major asset classes themselves. So one of the things you can do, Stephanie, to try and manage your risk, and this is to all people who are investing, if you want to manage your risk, you diversify. Now, I really want to hold on to this point very carefully because a lot of people diversify a little too early. Okay, I always say first get good at investing in something, then diversify into many things. But first, actually get good at the act of managing your money, of making money, managing it, saving it, and multiplying it into an asset, and then maintaining that asset into a portfolio. Okay, first get good at that. All right. Then once you've done that cycle enough times, then naturally you'll start to say, okay, now what else can I add to my portfolio because I've learned the mechanics of investing. So diversification does not guarantee, Stephanie, that you will not lose money, but it is an important component in helping investors manage because there are some times where the stock market performs well. There are some times where the bond market performs well. There are some times when cryptocurrency performs well. There are some times when dollars perform well. As you can see when I show you those numbers every single day, how you'll see that dollars are up this much, but in this quarter they've done well, stocks have done well, but bonds slowed down. These things change. So you want to kind of mix and match them to balance them out, okay, so that you can have a steady return. Because as an investor, remember, you value stable growth more than high growth. You value stability, okay? Yes, you want to beat inflation, but your first value is stability, because you want to make sure that you've got stable and steady growth, because slow and steady wins the race. The other thing you're looking for is you want to spread your risk amongst many investment vehicles that have not historically moved in the same direction. Bonds and stocks don't tend to move together. Okay, the Bitcoin market doesn't tend to move with them. These things don't move together. So you want things that don't move together, and stay diversified in different types of investments. This includes, you may vary, if you're in the stock market, some of them you may have agriculture, somewhere you may have mining, somewhere you may have banking, somewhere you may have the service sector. So you want to kind of mix it up so that you're not caught in a industry tailwind. Okay, remember that you saw there that the illicit market is affecting cigarettes as an industry. So imagine if all your stocks, if there were plenty of cigarette brands and you invested across them, you'd actually be hit by the illicit market one time. So this is what diversification calls for, not putting all your eggs into one basket. Now, I want to make a point here, Stephanie. There is a harsh misconception I've seen when it comes to investing, where or when it comes to wealth building, where everybody has this conversation about what we call multiple streams of income. So I've seen people quickly diversifying their income, but concentrating their investments. They'll put all their money in one place, but they'll try and have multiple streams of income. And they'll say, yes, the wealthy have multiple streams of income. And that's true, but that happens over time. Usually what they've done is they've created multiple assets which create multiple streams of income. That's what a lot of them have tended to do. They've created multiple assets, and it has happened organically. It's not a forced thing. So I always say, concentrate your time in a singular activity, derive as much value from that thing. Remember, we talked about career capital yesterday, by focusing on something, and then gain as much value and pay from that, and then utilize that premium earning that you get to diversify into a set of assets. So I always say, concentrate your time, diversify your money. If anybody's writing that down, that's extremely important. Concentrate your time, but diversify your money. That, I think, has been one of the greatest ways to do this. Also include securities that may vary in risk. You don't have to restrict yourself to only top mega cap stocks. You can pick some of the growth ones that are down there as well. And however, this will not protect you against what we call systemic risk, when the whole economy turns down. And finally, I wanted to talk, before I go, next week I'm going to be talking about the Bridgewater method of diversification, and this will kind of bring all of this home. I want to talk about black swans. Now, black swan events, Stephanie, are things that you cannot predict. They are unbelievable things that happen from nowhere. A pandemic that shuts down the whole economy. A war that breaks out in Russia, Ukraine, and affects the global energy markets. Those are black swan events that have broad systemic impacts. Traditional risk management models are not adequate. So how do you deal with black swan events? Look at your portfolio of assets. Are they able to defend against black swan events? Test against scenarios. Assess the extreme situations that occur. Okay, what happens if inflation gets to 30%? Have you got agile enough assets that can adjust? Or have you locked your money into things that will get weathered away by inflation over a long period of time? Are you maintaining wealth diversification? Are you also adding what we call wealth insurance assets, your dollars, your cryptocurrency, so that they're about 5 to 15% of your portfolio? Are you holding adequate cash reserves in case of a downturn so that you can go into the market and buy up assets? And are you able to adapt to evolving market conditions? Do you have enough data? Are you subscribing to information so that you can move and adapt your portfolio quite well, so that you can see these things slightly at the beginning, or at least slightly before they happen? So these are some of the risks that we're looking at whenever you're trying to invest. And I know today it's getting a bit technical, and I understand that. But if you're catching a little bit of it and you're trying to pick this up, what I can tell you is you always want the risk you take to be somewhere around the reward you get to be 3 times the risk you take. That's the most important thing. Risk is the risk is the cost of building wealth. Diversification will not automatically save you, but it happens organically, and it can reduce the impact, and it can help you with stability. And also expect the unexpected. Sometimes the unexpected can happen. Are you ready for the worst case scenario? That doesn't mean it's always going to happen, but are you ready for black swans? Do you understand those things can happen? And are you agile enough? So this is what I wanted people to understand with risk before I take you through the Bridgewater method of risk hedging, which is going to be the whole of next, which is going to be next week on Wednesday. I'm going to take you through that. That's going to be critical as to how you build a portfolio. But today, Stephanie, I will bring that down and and leave that be. I don't know if you have anything else for today.
No, not really.
All right. So I wish you all a wonderful day. God bless. And thank you to all who have been following.
Thank you, Munyum.